Welcome to the Silent Trading channel on Sunday the 29th of March. Today we're going to be analyzing the chart and updating about where would be the best position to enter for the next week. And to be able to enter at the best position is not the only solution, but also to be able to manage your position if it is going to a drawdown. But before I start, please subscribe, like, comment and share if you like this video and to support me in my trading journal, right? So today I'll be starting first on a weekly chart because we are gonna be looking at a week chart first. Because why? It is to see whether the bias or the trend for the next week will be on a bullish side or a bearish side, and if it is going into a bullish side, how long would it go into the bullish side before it start reversing into the bearish side, right? Because why? Because every candle has to have both a bottom and a top wick, which means if the next week candle push up first to create a top wick, right? Push up first to form a top wick, and then it start reversing, we are gonna be selling on a reversal, correct? Because why? If it is pushing up and then start reversing, or it can be start doing a pullback, we will start to sell on the pullback, but we are not selling at the weekly chart because we will be looking at a 4-hour time frame or the daily time frame to see the best possible spot to enter a position, correct? So since right now we see that the weekly time frame has already pushed down, right, and the previous candle has pushed down on the chart and then start pulling back, it is showing us that after clearing off buy side volume enough, it start to clear off sell side volume by pulling back. Because why? Because every time the chart start pushing up to attack resistance, it is telling us that people are entering a sell or a short position at every resistance there is in the chart, no matter in the higher time frame or the lower time frame, which means this pullback is telling us that there are people selling below, correct? There are people selling and they are right now in a drawdown below. So which means after leaving sellers into a drawdown below, the next week chart may have to push up further, right, to pressure sellers into closing their position before it start pulling back and then start pushing down. Or it could do what? Or the weekly time frame could push down first, right? On the weekly time frame could push down first, right? Pressurize sell buyers, pressurize buy position holders into closing their position before it start reversing. And a reversal is not on a weekly time frame. It could be on a 4-hour time frame. It could be on a daily time frame. But on a weekly time frame, it is just pushing down to form a bottom wick before it start pulling back and then start pushing upwards, correct? So if the next week candle start forming a top wick first, we believe that it is pushing up to clear off sell side volume, forcing sell side volumes into closing the position, right? But if it is pushing down first, it is forcing buy side volume into closing the position, right? Taking out buy side volume before it start pushing up. If it start pushing up first while not attacking resistance, it is forcing sell side volume out. It is taking sell side volume out, right? And after taking out enough sell side volume, it will then start pulling back, which in the 4 hours chart scenario, it will start reversing, correct? It will start forming a bearish price action and then start attacking support, correct? So if we see in a weekly time frame next week, it start pushing up to create a top wick first, do anticipate that it is creating a top wick just to pull back and then dump. Right? If it is creating a bottom wick, it is creating a bottom wick to just pull back and then push up, right? So we are not going to be having wishful thinking that it is going up, that it is going down. We will be doing detailed analysis about why the chart is going up and how is it going up and on what basis that it is going up, right? We do not have wishful thinking on the chart that it is going up because we want it to go up, it is going down because we want it to go down. No, we will be doing detailed analysis on the basis of price action, on the basis of human psychology, which we have studied, and we can anticipate and we can speculate that there are certain spots that there will be retail traders buying, there will be retail traders selling, and those are the spots that we wouldn't be entering a position. Because why? Because retail traders entering a position means that the chart is going to dump on the retail traders, right? So if retail traders are selling, the chart is going to fly up further and further, and if the retail traders are buying, the chart is going down, correct? But if retail traders are selling, the chart is going to keep expanding upwards, correct? So every time we analyze the chart, we analyze based on the reasoning that price action is formed, and price action is formed based on human psychology too. Because why? Because if price action is on a bearish side, but human psychology, right? If price action is on a bearish side, but people are going to sell, right? It can also reverse into the bullish side. Why? Because you should always remember that the big money, the smart money, will never ever allow the small money to profit off from them, right? Because liquidity is provided either by the big money or the small money, right? So if the small money is winning, who is providing the liquidity? It is the big money, it is the smart money, the institution, the banks, correct? The hedge fund, right? But if the big money is winning, who is providing that liquidity? It is a small money, correct? It is a small money opening a position, it is small money buying spot, right? It is a small money opening a position, even both against the trend and both along with the trend. But the big money always has a way to attack stop loss from both sides. You can either be buying, you can either be selling, but they always have a way to take out your stop loss. They always have a way to take out your position before they go on the initial trend. So always try to understand the chart before you're entering a position, because the best possible position to enter is the spot where most retail traders are taken out, be it on the sell side or the buy side, right? I will never ever be biased on any side of the trend, on any side of the chart, because we will be trading based on price action, we will be trading based on human psychology, which means if the price action is bearish but people are also selling, it can also change to bullish side at the next moment. And also if the price action is bullish but people are buying, the market, the big money, can also force the chart to dump before going on its initial trend. So never ever be careless, right? Never ever have too much confidence in yourself, in the chart, because the chart can always change its direction. The chart can always go against you anytime. Even if going against you for a moment and taking out your stop loss before going on its initial trend, it could always happen. So right now we believe that the weekly time frame has a way of doing both things. So we are going to be looking at a 4-hour time frame. If the 4-hour time frame on tomorrow, right? If the 4 hours chart tomorrow push up and then breaking all this resistance first, the next candle retracement is where we're going to be buying. But since it has already formed a triangular sideways frame, we believe that this triangular sideways frame can hold, which means if this sideways frame is going to hold, if this border is going to hold, means that the chart has a chance of pushing down and forming a bearish price action. And if a bearish price action is really forming, the next candle retracement is where we're going to be selling. Because why? Because if this triangular frame, right, sideways frame here over here, is going to hold on, it is going to force the chart, it's going to force the market into going to a bearish price action, into going to a bearish trend, right? And after going to a bearish trend for a certain period of time, or after going to a bearish trend until it has drop down to touch the lower border over here, and if it is able to start reversing from this lower border, we can then start buying at the next candle retracement. Correct? So if price action is happening based on your understanding, you can enter a trade, but if not, never enter a trade carelessly, because there are risks, right? There are risks worth to be entered, and there are also risks that are not worthy to be entered. Because why? Risk can have multiple kinds of risks. There are riskier one, there are less riskier one. There can also be risks that are manageable and risks that are not manageable, which means always enter a position at the spot where risks are manageable. If there are spots that risks are not manageable, we are not going to enter a position, because entering at a too risky point can cause you to lose a lot of money. Okay, so for tomorrow I'm gonna be analyzing for you guys again, so we'll look forward to be seeing each other again tomorrow, and that will be all for today that I'm analyzing, and I'll see you guys tomorrow. See ya.